someone told you that you needed 20% down to buy a home, and you believe them. So if you've been sitting on the sidelines, saving, waiting, and watching prices move higher every single week, paying rent every month to someone else's mortgage, here is the truth. 84% of renters believe they need 20 to 25% down to buy. The actual median first-time homebuyer in 2025 put down 10%. Some put 5% down, some even put 3% down, and some actually had no money down at all. The 20% down rule is not a law. It's not a requirement. It is a myth that has kept qualified buyers renting for years longer than they ever needed to. And by the end of this video, I'm gonna show you the real numbers, the real options, and exactly what waiting for 20% down is actually costing you every single month. If you're new here, my name is Eric Hamilton. I'm a branch manager and senior vice president of mortgage lending at Rate in the Chicagoland area. This channel is called Apply with Eric. Every week we cut through the noise, we kill the myths, and we give you real mortgage and housing strategy based on data, not fear. If that's what you've been looking for, hit subscribe. I put out market intelligence every single week, the stuff your lender probably is not sharing with you. Now, let me show you exactly where the 20% myth came from, why it's stuck for so long, and why it's costing people years of their financial lives and lost equity gained. The 20% down rule did not come from nowhere. Decades ago, when home prices were a fraction of what they are today, lenders wanted to see 20% down because it protected them from risk. If you had real skin in the game, you were less likely to walk away from a home. And back then, getting the 20% was actually achievable in a reasonable time frame. The math actually worked. But then the housing market has changed a lot over the last several years. Prices climbed, and the advice never got updated. So people kept repeating it. Parents told their kids, financial articles repeated it. And the entire generation of home buyers internalized a rule that no longer reflected reality. Today, 20% down on a medium-priced home in Chicago means saving anywhere between $70,000 and $90,000 before you can even start to look for homes. For most first-time homebuyers, that is 5 to 7 or even 10 years of saving, while prices kept moving higher over that time frame. That is not a financial discipline problem. That is a financial delay problem. Let me show you what first-time buyers actually can put down today. Not what they think they need, what they can actually do today. According to the National Association of Realtors, the median down payment for first-time homebuyers in 2025 was 10%. So on a $450,000 home, that is $45,000, not $90,000. And that is the median. Many buyers actually put down less. Conventional loans allow as little as 3% down for qualified first-time homebuyers, and that's only $13,500 on that same house. FHA loans require 3.5% down with a credit score of 580 or above. VA loans actually qualify with no money down, 0 down on a VA loan. USDA loan in eligible areas also requires 0 down. So when someone tells you that you need 20% down to buy a home, the correct response is compared to what loan program? Because the options are 0% down, 3% down, 3.5% down, 5% down, 10, 20% down is not the floor. For most programs, it's not even relevant that you need 20% down. Now I want to show you the number that nobody talks about. And this is where it gets really important to understand your options. Not how much you actually need to put down. How much waiting is actually costing you while you accumulate the savings of 20% down. So let's run a real scenario. You have $30,000 saved. You're looking at a $400,000 home. You think you need another $80,000 before you can buy. So you keep saving. At $1,000 a month in additional savings, you are 4 years and 2 months away from your 20% target. Here's what happens during those 4 years. You pay rent. Let's say it's $2,000 a month. That is $100,000 in rent over 50 months. Gone. No equity, no ownership, nothing to show for it. Meanwhile, that $400,000 home appreciates at a conservative 3% annually. By the time you hit your 20% number, the home now costs around $449,000. So your 20% target moved from $80,000 to $89,800. You saved $50,000 over those 4 years. The goalpost moved by nearly $10,000, and you paid $100,000 in rent. The cost of waiting for 20% was $100,000 in rent, a higher purchase price, and 4 years of equity you will never get back. Now compare that to the buyer who purchased the same $400,000 home 4 years ago with only 10% down. They ended up putting $40,000 down. They did pay PMI mortgage insurance. Let's call it $150 a month for those years. That is maybe $7,200 total in mortgage insurance. And they now have roughly $60,000 in equity from the appreciation alone, plus the principal that they've paid down over that time period. $7,200 in PMI to avoid $100,000 in rent and capture $60,000 in equity. That is not a close call. That is a smart financial decision. So I have a quick question for you. Before watching this, what number did you think you needed for a down payment? Drop it in the comments. I read every single comment, and I guarantee you most of you are going to see the number that surprises you from other people in this community. Now let's talk about the objection you are already forming in your head. What about PMI? Private mortgage insurance is what you pay when you put less than 20% down on a conventional loan. And most people have been taught to treat it like a penalty, a tax for not being ready enough, and why many save for 20% down. But here's the reality. PMI on a $400,000 home with 10% down typically runs anywhere between $100 to $200 a month, depending on your credit and loan structure. It is temporary. The moment you reach 20% equity, either through payments or appreciation, you can request to have it removed. In a market where homes are appreciated at 3% or more annually, a lot of buyers hit that 20% threshold much faster than they expect. So the question is never just, should I pay PMI? The real question is, does paying $150 a month in PMI make more sense than paying $2,000 a month in rent while prices move away from me? Most buyers, in most situations, PMI is not the problem. It is the solution to getting started earlier. So let me walk you through what is actually available to most buyers right now, because most people have never heard any of this from a lender. Conventional loans allow 3% down for qualified first-time homebuyers through Fannie Mae and Freddie Mac programs. Income limits do apply, but more buyers qualify than realize. FHA loans require 3.5% down at a 580 credit score or above, one of the most flexible programs for buyers who have had credit challenges in the past. VA loans for veterans and active service members, 0 down, no PMI. This is one of the most powerful financial tools in existence, and it's massively underused. USDA loans in eligible suburban and rural areas also have 0% down. Most people think this only applies to farm country. It does not. And on top of that, Illinois has down payment assistance program that can layer on top of these loans grants, forgivable loans, programs specifically for first-time homebuyers, teachers, healthcare workers, first responders. Many buyers who think they are years away from buying are actually months away. They just don't know these programs exist. The 20% barrier is not real. The education gap is the problem. Here's how we approach this for every buyer we work with. We start with a real conversation about where you're at, a discovery call. We talk about what you have saved, what your income looks like, what program you actually may qualify for. Our team makes sure the process moves fast and nothing falls through the cracks. Our team works directly with your realtor from day one, so everyone is aligned on what you're approved for and how to present your offer. And we use a system called Gateless, our real-time file review system to clear your file before your offer is ever written. So you know exactly what you can buy, at exactly what payment, and whatever down payment actually makes sense for your situation, and no surprises later. Not the down payment sum rule from 1985 that says you need 20% down. The down payment that is right for you and your income, your goals, and your timeline right now. We have helped buyers get into homes with 3% down who thought they were 5 years away. We have helped veterans use their VA benefit who had no idea they qualified for 0 down. The gap between where most buyers think they are and where they actually are is almost always smaller than what they think. This is what we do. We close that gap and we help buyers purchase every single day with less than 20% down. The 20% down myth has kept more qualified buyers out of homes than any interest rate ever has, or inflation, or concerns about home prices. You do not need 20% down to buy a home. You need the right information, the right loan, and someone who will actually run your numbers instead of guessing. If you want to know exactly what you qualify for right now, the link is in the description. It just takes minutes. We use a soft credit pull. no impact to credit. And if you know someone who has been sitting on the sidelines because they think they need 20% down, share this video with them. You might be the reason why they stop waiting. I'll see you on the next one.